The first day without looking at the chart. A psychological and behavioral finance perspective. For many investors and traders, the first day without checking price charts feels uncomfortable, even unnatural. What seems like a small behavioral shift can trigger significant psychological reactions. This phenomenon reflects deeper mechanisms in attention, habit formation, and emotional regulation. 1. The habit loop. Why chart checking becomes automatic. Repeatedly checking charts forms a behavioral loop. Cue market open, notification boredom. Routine open trading app. Reward dopamine spike, gain, relief, novelty. Over time, this loop becomes automatic. Neuroscience research suggests that unpredictable rewards, like market movements, strongly reinforce compulsive checking, similar to variable reward systems used in digital platforms. The first day without charts disrupts this loop, which explains the mild anxiety or restlessness many investors feel. 2. Illusion of control. Behavioral finance research shows that investors often overestimate how much monitoring improves outcomes. The illusion works like this. If I watch closely, I can react faster. If I react faster, I'll reduce losses. Therefore, checking constantly protects me. However, constant monitoring frequently increases emotional trading rather than performance. Studies influenced by the work of Daniel Kahneman show that frequent evaluation amplifies loss sensitivity, a concept sometimes described as myopic loss aversion. More exposure, more perceived losses, more emotional reactions. 3. Emotional withdrawal effect. The first chart-free day often produces anxiety. What if something is happening? Fear of missing out. Phantom notification reflex. Urge to check just once. This resembles mild withdrawal from a stimulation habit. The discomfort is usually not about portfolio risk. It is about reduced stimulation and perceived disconnection. 4. Performance paradox. Less watching, better outcomes? Research suggests that investors who check portfolios less frequently tend to trade less, experience lower stress, avoid overreaction, achieve better long-term outcomes. Frequent monitoring magnifies short-term volatility, which triggers emotional decision-making. Long-term investing benefits from reduced noise exposure. In other words, the less you watch randomness, the less randomness controls you. 5. Identity shift, from trader to investor. The first day without charts often feels like loss of identity. If you define yourself as active, in control, engaged, then not checking may feel like neglect. But long-term capital growth typically rewards patience, process discipline, structured review intervals. Not checking the chart is not inactivity. It can be strategic restraint. 6. What actually happens on that first day? Objectively, markets move. News flows. Prices fluctuate. Subjectively, your stress level may initially rise. Then it stabilizes. Then clarity increases. Many investors report that after a few chart-free days, decisions feel less urgent. Thinking becomes more analytical. Long-term goals regain focus. 7. Strategic alternatives to constant monitoring. Instead of impulsive checking, predefine review intervals, weekly, monthly. Use alerts for meaningful thresholds. Focus on thesis review, not price movement. Separate information time from reaction time. Structure replaces compulsion. Conclusion. The first day without looking at the chart is not about missing information. It is about confronting dependency. Markets do not require constant attention to function. But our psychology often demands constant stimulation. The real shift happens when you realize you don't need to watch every movement to participate in long-term growth. Sometimes, the strongest position is not on the screen. It is in the discipline to close it.